If you're a real estate investor, you've probably heard about fix and flip loans. But what exactly are they? How do they really work? And how do you get one? Hey everyone, in this video, we'll be going over the ultimate guide for the fix and flip loans. Everything you need to know about fix and flip loans is going to be in this video, so stay tuned. Welcome back to the channel. If you're new, this channel will be focused on everything investment wise. Pretty much, we're looking to make money. Now let's get into the video. Let's start off with what a fix and flip loan is. A fix and flip loan is a short-term financing option designed for you to purchase a property that's distressed and has a higher potential value once the work has been completed. So it's designed to purchase, renovate, and then sell, or you could refinance and do the BRRRR method, the BRRRR method. Unlike traditional mortgages, these mortgages last 6 to 12 months and are based on the property's potential value rather than just your DTI. One of the great things about fix and flip loans is there's no debt to income ratio. And who are fix and flip loans for? Fix and flip loans are for anyone who's looking to purchase distressed properties and renovate them for a profit, or investors looking to do the BRRRR method, which is buy, renovate, refinance, rent, repeat. It's also great for people that are lacking capital to buy a property outright cash. Now let's go over how fix and flip loans work. Here's a quick rundown. 1. You find a distressed property to purchase. Make sure that the property is undervalued and has a good resale value once the work has been completed. 2, you secure the financing. So once you find the property, then we secure the financing. You purchase the property with the loan, then you start the renovation process. Then you'll sell the property or refinance and do the BRRRR method. Simple, right? But there's a lot more to it than that. So we'll be breaking down each one of those sections. Now, before we get into those, let's start off with what types of fix and flip loans are out there. You have hard money loans, which basically focuses on the property itself and not too much on credit. There's private money loans, where you can reach out to private investors to help fund your deals. You can use HELOC, which is home equity line of credit, or a home equity loan. You pull the money out of your primary to do the purchase and the renovation. And then there's bridge loans, which we do, which is short-term financing that bridges the gap until you either sell the property or find other financing. And we can help you with that. In this video, the main focus is bridge loans. Now let's go over the qualifications for the fix and flip loans. Some important terms to keep in mind are ARV, which is after repair value, LTV, which is loan to value, and LTC, which is loan to cost. Now, after repair value is the value of the property after the repairs have been completed, like it says. So let's say you're looking at a property that's $100,000, it needs about $75,000 worth of work, and then it will be worth $250,000. So the after repair value would be the $250,000. Loan to value measures the loan amount as a percentage of the value of the property. Loan to cost measures the loan amount as a percentage of the total cost for the project. The total cost is made up of the purchase price and the rehab cost. After repair value is typically 75% with majority of lenders. The ARV sets the stage for your project, guiding your budget, profit goal, and financing needs. The LTV will show you how much cash you actually need for the down payment. The LTC keeps you grounded. This gives lenders confidence in your project, ensuring that you're not biting more than you can chew. So these 3 terms are very important to help you not waste any time and to make sure that the numbers make sense for the lender as well. Now let's go over an example to break this down so that you understand it. Let's say that you find a property that's worth $100,000. The property needs $50,000 worth of renovation costs. And let's say the property's after repair value will be $250,000. Lenders offer an LTV between 80% to 90%, and it depends on experience as well. Some lenders may go a little higher than 90% as well. So what that basically means is that you have a down payment of 10 to 20% for the fix and flip loans. For our example, we're going to assume that you're newer or less experienced, so you'll have to place a 20% down payment, which will give you an 80% LTV. Now, when we calculate the loan to value, we go based off of the purchase price. So if the property's purchase price is $100,000 and you have to place a 20% down payment, which will give you an 80% LTV, that means that the loan amount will be $80,000 and the down payment will be 20%, which is $20,000. If the lender offers an 85% loan to cost, what we'll have to do is add the purchase price of $100,000 and the rehab cost of $50,000, which will give us $150,000 total. Then we'll have to find 85% of that $150,000, which is $127,500. And the lender is capped at a 75% ARV, after repair value. So we'll have to do 75% of $250,000. 75% will be $187,500. So it's very important to check your loan to value, loan to cost, and after repair value. Majority of lenders will look at all three. Different lenders have different LTVs and LTCs and ARVs. So it's very important when you speak to your loan originator to see what your options are. Luckily, I have multiple options. So if you ever have thoughts of applying for a fix and flip loan, feel free to click on that link in the description below, fill out that form, and we'll be happy to run that scenario for you. So the ARV is 187,500, the LTC is 127,500, and the LTV is 80,000. So as you can see, there's room between the after repair value and the LTC. So majority of lenders are 100% good with that. Now let's go over the qualifications. Now, every lender has different qualifications, but we'll go over the most common ones. For credit score, you'll typically want a credit score higher than 620. And keep in mind, with lower credit score, it might limit the loan to value. So you might have to come up with more down payment, more skin in the game, especially if you're brand new. Now let's go over experience level. Some lenders prefer to work with just experienced investors. However, there are still options for first-time investors as well. Typically with first-time investors, you will have to place a higher down payment. Down payment is usually 10 to 25% of the purchase price. Lenders will lend an ARV up to 75% typically. A very important thing to focus on is an exit strategy. Now let's go over some important factors to consider when getting a fix and flip loan or getting into the space of fix and flipping houses. The most important thing is to make sure that the value is there. Make sure the LTC, LTV, and ARV works. And make sure you find out what the actual renovation costs are. So when you go to view the property, make sure you bring along a contractor who will give you estimates. Once they give you that estimate, add another 5 to 10% in for renovation costs, just in case something comes up. An important tip is to check for permits if there's an addition or if the roof was recently done, so you don't get screwed. Because if the permits weren't pulled and you have a completed addition with full sheetrock plumbing and everything, they're gonna want you to rip that sheetrock down. They're gonna wanna make sure they check everything out and clear it. So make sure you take that into consideration. Make sure you have a reputable contractor who knows what they're doing so that they can give you a more accurate estimate. So once you view the property, make sure your contractor goes with you. You'll have to complete a scope of work, which is basically a document mentioning what exactly needs to be done in what area, and it's very detailed. For example, let's say for the kitchen, you're looking to do new countertops. You plan to put granite countertops in there. You plan to put stainless steel appliances in there. So in the scope of work, you break down in details what you're doing. Once you complete the scope of work and the purchase price and ARV makes sense for you, and it's very important to add another 5 to 10% onto that renovation cost, just in case it ends up being more. There's been a few times where people underestimate what the actual renovation will cost and then have to come up with money out of pocket or figure out an exit plan. And it's very important to have an exit plan. Are you planning to sell or refinance? If you're planning to do a refinance after, it's very important that you watch this other video I made so that you don't run into any issues. I'll link it somewhere on the screen and I'll put it in the description. Now let's talk about some costs. So we went over the down payment. Let's go over origination fees. Origination fees are anywhere from 1.5% to 5% of the loan amount. Depending on the lender you go with, they may also charge some points. Repayment terms are typically 6 to 12 months. Some lenders will give you extensions. Some lenders will actually offer all the way to 24 months. Typically, you're paying interest only on these loans. So for 6 to 24 months, you're just paying the interest. The name of the game is to finish this renovation as fast as possible, so you're paying less interest and you're getting that profit. So it's very important to finish the project as fast as possible so that you can either sell the property or do the refinance. Let's go over common mistakes investors make on the fix and flip loans. First one is underestimating renovation costs. As we went over a little earlier, you'll have to make sure that you have a reputable contractor who knows what he's doing, and then once you get the full amount, you add 5 to 10% on top of that. And make sure you check out all the permits. If there was a recent addition or if there was a roof work done, make sure you check the permits so that you don't have to spend money ripping stuff down to make sure it passes, then doing it over. Another mistake is ignoring the market trends. Make sure you study the market that you're targeting. Find out whether it's going up or whether it's going down. Another common mistake a lot of investors make is overpaying for the property. So it's very important, again, to make sure you find out what the costs are, the purchase price, the total rehab costs, and the after repair value. Sometimes investors get caught up in these bids and overpay for the property. Now, don't get me wrong, going over asking, sometimes it makes sense, and then there's sometimes it doesn't. That's why it's very important to pay attention to the market trends in that area. So if you do purchase at a higher value, which I've seen investors do, in my area, then there still could be room to make a significant amount of profit. Another common mistake is failing to have an exit strategy or failing to be clear on the exit strategy. Remember, when you're selling the property, if that's your goal, there are also closing costs involved in that. There might be attorney fees, there'll be real estate agent fees. Make sure you find out what those fees are and take them into consideration. Or if your goal was to do the BRRRR method and refinance the property, then you have to make sure that the property will be eligible for that refinance in the first place. I made a video that is very important to watch if you're planning to do the BRRRR method, which I will link in the description and somewhere on the screen. So make sure you watch that. It's very important if you're planning to do a refinance. You have to take into consideration the LTV for the refinance, depending on the cash out or rate in term. You have to take into consideration the area. Majority of lenders don't lend in rural area. The type of property it is, the rent amount that you're going to get from it, the rate that you're estimated to get. It's very important to go into detail on your exit strategy. Now let's go over the process of doing the fix and flip loan. First, you're going to look at a property. You're going to bring a contractor in. You're going to get a scope of work done. Now the scope of work is basically going to go over the details for each renovation. So if you're planning to do kitchen renovations, in the kitchen section, you'll list out exactly what needs to be done. You're renovating the countertops. You mentioned, hey, I'm renovating countertops, I'm placing granite countertops. Here is the expected cost. So that's why it's very important to have a reputable contractor or an experienced contractor who knows what they're doing and who knows cost of material and labor. Now, once you complete your scope of work and the property makes sense, you find out the ARV, the LTC, and the LTV, it makes sense for your goal, then you would apply for the loan. Now, if you're interested in applying for a fix and flip loan, feel free to click on the link in the description below, fill out the form, and we'll be happy to help you out. Now, there's a list of documents required initially for submitting a fix and flip loan. They'll need a copy of your ID, they'll need a copy of the purchase contract, they'll need a copy of your 2 most recent bank statements to show proof of down payment and closing costs. And if this is closing in an LLC, they'll need your operating agreement, your articles of organization, and your EIN document. They'll also need your scope of work, which we went over. Once all these are submitted, you'll also have to fill out an application. Once they pull your credit and you meet the credit eligibility, they'll figure out which lender you're going with, and we'll go over the terms. Once you submit your loan, the lender will review your file and may come back with a list of conditions that needs to be satisfied. Your loan originator will then go over that list of conditions with you, and simultaneously, we're ordering the appraisal and title. Once the appraisal's back, title's back, and everything is good, and all the conditions are in, then you get declared to close. Now that you're closed on the property, you can start the rehab. And while doing the rehab, once you complete certain phases, you'll request a draw. So you'll pay for the renovation costs up front, and then you'll get a reimbursement from the draw. Depending on the lender we go with, you'll have different amounts of draw. Once you complete the renovation, then you either sell the property or do the BRRRR method. Again, it's very important to watch my video of doing the BRRRR method so that you don't make any mistakes and don't lose any money. And again, I'll be linking that in the description and somewhere around here. And that's the process for a fix and flip loan. I hope all this information was helpful for you. If you had any questions, let me know in the comment section. If you thought it was valuable, make sure you like and make sure you subscribe and hit that notification bell so you don't miss out on any more videos I'll be making. Thank you so much for watching.